Thank you for joining us in our first webinar of 2026, the AI Economy Market Outlook for 2026. My name is Gerry Celaya, the Chief Strategist, and leading off today is going to be John Calverley, Chief Economist of Tricio.
Okay, thanks, Gerry. And so I'm going to be talking about the AI economy, and I think it's undeniable that AI has played a huge role in US growth over the last year. So the agenda today is I want to look at whether this, what I call AI boom, will last, and then more in a slightly longer term view, how will AI impact profits and productivity, which is going to be crucial for firms and for stocks, but also for the economy and for other aspects. I want to look at whether AI can compensate for some of the rather erratic policy that we're seeing and indeed rising government debt. I think you can argue that without the AI boom last year, US growth would have been a lot lower because of Trump's tariff shock. But in a sense, AI compensated for that. But will it continue to do so? And then I want to back off a bit and talk about geopolitical risks. Perhaps after Trump's climb down yesterday, that's a little bit less at the front of people's minds, but I think it's worth thinking about in terms of how investors should position. Gerry will then talk about our market views, looking at some charts, and then James is going to talk about how to deal with the geopolitical risks in a sort of general sense. So let's start with the outlook. And I'm inclined to argue that the US is in a strong place right now and is likely to stay pretty strong this year and next. First of all, the AI investment we've seen is likely to continue at a high level, at least in the near term. And I'll show a slide on that in a moment. Then the wealth effects from stock gains, I think, are still there. Stocks may or may not continue to rise rapidly, but people have big benefits already from the gains of the last few years. Then we have the One Big Beautiful Bill Act, which is creating tax cuts for overtime, tips, seniors, and quite a lot of Americans will get rebate checks in the next few weeks, larger than they would expect. And I think that'll be spent. Then you've got lower interest rates. So even the cuts back in 2024 may still be working through, and we've had three new cuts in the last few months. Deregulation, I think, is a stimulus. We've seen that particularly in the energy sector, oil and gas, but also in the financial sector, which I think may have a role. And then it's a midterm year, and I think we may well see more government spending come through as the year goes on. President Trump himself has talked about giving checks, cash to everybody. Don't think that'll happen. Might do, probably not. He's also talked about more defense spending. But either way, I would expect the spending taps to be pretty loosely on this year. There are some headwinds. So the average tariff rate at the moment is around about 16%. I think the sort of initial shock that we had last April is well over now, but obviously Trump is still behaving erratically on this, so that could still be a problem. And the other thing I'll talk about is what's happening in the jobs market, where we've seen very weak jobs growth. And there is some concern that if that was to continue and incomes and jobs decline, that could have more of an impact in slowing the economy. But let's look at the capital investment boom. And this chart just shows the investment plans of the top five US firms: Alphabet, Amazon, Meta, Microsoft, and Oracle. So you can see in 2024, they spent 260 billion. The estimate for last year was 433. And for this year, they're planning to spend 633. So the difference, 433, 633, that's $200 billion. That's about 0.6% of GDP in itself. That's just the top five firms. Now, admittedly, some of that will be spent on imports, but nevertheless, it is just the top five firms. So there's a lot of other spending going on. So I think this is likely to continue. At some point, there's obviously a risk that there's some disappointment about the prospects of making money out of all this investment, but I don't think that's going to become evident just yet. And I think these firms will continue to try to invest to be out in front to get the sort of first mover advantage. Turning to the wealth side, the wealth effect side, this chart shows household wealth as a percent of personal disposable income. There was a spike just after COVID. That was partly because disposable income was right down. Also because that was the period of the very strong growth in housing prices and in stock prices back in 2021. But if you just look at where we are now, we're about 8 times income, and pre-COVID it was about 7 times income. So pretty meaty increase in wealth in relation to incomes. Now that's obviously not everybody in the US. Some people in the US are struggling, particularly if they don't own stocks, which is the majority, and particularly, especially if they don't own a house, which is about 30%. Those people, rents are rising, food prices rising, they're struggling somewhat. But certainly the top 20 to 40% of people are doing pretty well. That's their wealth there, and they're inclined to spend. And you see that in this chart, which looks at the savings rate in the three regions. So we just look at the US first, the red line. Before COVID, the savings rate was about 7%. Went up, of course, during COVID. You couldn't spend money. And then it came down again and it stayed down. And recently it's been falling. So it's around 4% of income at the moment is saved. All the rest is spent. But that's a high spending rate. If you contrast that with the UK, where the savings rate came down after COVID, but then has gone up for the last 3 years. And that's a key reason why UK demand has been slow. No big surprise for that, obviously, with all the threats of higher taxes, with higher energy costs, with for many people, expectations of higher interest rates as their mortgage gets reset. But that's definitely held things back in the UK. Big contrast with the US. And the green line shows the Eurozone somewhere in between, not as bad as the UK, but nevertheless, the savings rate has gone up. So this is one of the headwinds, what's been happening to jobs growth. And most recently, the overall jobs growth has actually been negative on a 3-month basis. If you take out the government sector, it's about flat. There was a big drop in government jobs that came through in October because of the timing of the Doge job cuts. But as you know, one of the things that has been going on in the US is the so-called border control. So we don't quite know what's actually happened to net migration. There are different estimates. One came out yesterday from Brookings, which suggested that there was a net migration out of the US of perhaps up to about 300,000. That's in a big contrast to the previous few years, where there was a couple of million, 2.5 million on average, 22 to 24 coming in net. But what it does mean, if there's no net migration, is that the number of new jobs you need to create just to keep unemployment about steady is quite low. Again, estimates vary, but it may be as low as zero, probably not higher than 50,000 a month. So as long as you see jobs growth coming in that sort of area, you're not going to see a big rise in unemployment. That seems to be the pattern where we are at the moment. So at the moment, I don't think this is going to be a huge problem. What seems to have happened is that some firms have been reluctant to hire because of uncertainty over tariffs, worries about the economy. But as we're seeing, the economy appears to be very strong, and I don't think those worries will continue. And especially because of this chart, if you look at profits here, this is profits after tax as a percent of GDP. It's the broad economy, not just the S&P companies. And you can see it's pretty high, and it's been rising. Usually you don't get a big slowdown in this circumstance. Usually this is an environment where firms are happy to hire and to invest. So again, I think this supports continuing growth and suggests we shouldn't worry too much about the labor market. So let's look at earnings, and this is a chart from the OECD, which I found rather interesting. The red dotted line there is the US technology sector, and this is showing the level of profits going back to January 2020, so just before COVID. And technology profits up 150% in 6 years. That's a 16% compound annual growth rate. So when you look at a number of the technology shares which have price earnings ratios in the sort of 30 to 35 range, they don't look so high because if you're actually getting double-digit earnings growth, especially up around 15%, that level is justified, that level of price earnings ratio. So obviously it then comes down to what you think about those individual stocks, and in particular, whether they're going to make money out of AI or not. And I'll come on to that in just a moment. Looking down a moment, I was moderately surprised to see that Japan came next. So Japanese stocks earnings have done extremely well, better actually than the S&P all sectors. And then Europe comes in below. And I put the 5-year market gains on the right, so you can see the topics has done about the same as the S&P 500. Obviously, the technology stocks in Nasdaq has done better, and the European stock market not so good over the 5-year period. And that broadly fits with what's been happening with earnings. But that's all historical earnings, what's been happening. Question is what's going to happen going forward. And I think here, frankly, it's very uncertain. US companies are aiming to produce the best AI models. They've got the best chips from NVIDIA and others. They've also got very high ambitions, talking about creating artificial general intelligence, whereas some firms are trying to simply hone in on a particular application. They're trying to do something more general, which, if it can be achieved, will certainly be a great achievement. But there is a debate about whether they're trying to do too much rather than getting the applications. And meanwhile, China is producing cheaper models, which may be good enough. And just under a year ago, we had the DeepSeek shock when they produced a model that did exactly that and was much cheaper to buy and to run. A lot of these Chinese models are open source, which appeals to some firms. China also has the advantage of having plenty of electricity, unlike the West, which is scrambling to produce the electricity needed for the data centers. I would also say China is well positioned to combine the AI with robotics because they have a huge robotics sector supported by the government. So, from the point of view of profits, then there's kind of two questions. First of all, will the models themselves become commodities? In other words, there'll be enough competition, maybe just among the US companies or maybe with the Chinese companies getting in as well, so that the prices of the models come down. And in effect, the users of those models, the business users, get the profits. That could happen. So that could mean that some of the huge investments we've seen by the top AI firms, they really struggle to get the returns. So that's a question mark. It's possible also that the profits will be competed all the way down to consumers. In other words, the users of these models won't be able to take extra profits because of this. And this is all still very much up for grabs. Obviously, all these firms are trying to get out in front, first mover advantage, creating a moat, whatever you can do to get you into that situation. You're finding that business users are often hedging their bets at the moment using several different models. It's all, frankly, very much in the wash at the moment. My hunch is that in the long term, most or maybe even all of the benefit will go to consumers. That's been the pattern, but that can take place over a long time. That can take 10, 20 years to all flow through. And meanwhile, firms can make a lot of money on the way. But I do think this is an area of huge uncertainty and one to watch and one to be a little bit nervous about when you see high valuations. What about productivity? And this chart shows some historical numbers for various countries. The main message, which you're probably aware of, is that productivity slowed down in most countries after about 2007, particularly in the UK. The UK has a particular problem. But if you look at the US there, the second set of blocks, productivity roughly halved. And if I look at the next slide, this is just focusing in on the US and looking at longer term. So there was this big rise in productivity after the war, Second World War. Then productivity dropped for about 20 years. Then you had another period of 3.3% productivity growth, 1995 to 2004. That was when the internet and the personal computer were kind of married together. And then it slowed down again from 2004 to 2024. At 2025, we've seen some very strong productivity numbers coming out of the US. Whether that's AI is not quite clear at the moment, or whether it's other things, potentially simply the high spending in the economy. Um, but if you were to go back to where we were before in the post-war period and around the turn of the century, you'd need about in this case, 1.6% increase in productivity to get back to those sorts of levels. And by the way, those past times when we had fast productivity growth, you didn't have a general unemployment problem. Unemployment was low post-war period, and it wasn't particularly high around the turn of the century either. So you'd have to have a massive gain in productivity for there really to be a general unemployment problem. That doesn't mean that individuals might be out of a job, but they'd probably find alternative places to go. So there's a lot of work going on in how much could AI add to productivity growth. And these estimates are usually task-based. So you look at what somebody does. Take an economist, for example, spend, let's say, a third of your time talking to clients, a third of the time doing data analysis, a third of the time writing. So maybe the writing can be accelerated, drafting or editing using AI. Maybe the data analysis can be accelerated. And you work out how much you could improve your productivity in those areas. But then, of course, you have to generalize that across the economy because there's going to be some jobs where it's much harder to use AI. Those sorts of estimates come up with something like 0.5% to 1% per annum for the next 10 years or so. There are some people who have come up with much bigger numbers, 2, 3, even 4%. There are also some people who come with lower numbers than that. I think that 0.5% to 1% is probably quite reasonable. May not sound like much, but it's actually very important. So what does it depend on? Well, it depends on the performance of the AI models themselves. And if you've worked with them, you'll know that they've improved massively in the last 3 years or so since the first ChatGPT model came out. But it also depends on the speed of deployment. How quickly do firms actually use them? And in many cases, it won't be that quick. It's difficult. There are the headwinds that I mentioned here. Firms are worried about the privacy of their data. They're worried about hallucinations, which have come down but are still there. They may need to reconfigure their whole processes, and that takes time. And then there's the broader question of reallocating labor. So, supposing a marketing person's made redundant, if they can get into another good job somewhere, that's good for productivity. If they end up flipping hamburgers, that's not so good. So that's a critical question. And then there's the question of regulation, which is still very much up in the air. Could affect AI, could help AI, but that's uncertain. So the point about the productivity is that rapid productivity growth can help with a lot of things. In particular, it can help with inflation, which is not quite beaten yet in the US or the UK. It's nearly there, and there's some optimistic signs that wage growth is slowing in both countries, but it's not quite there yet. And you can certainly make a case for the US, where if growth is strong, if labor markets tighten, and with net immigration or net migration out of the US, that's a risk. If the new Fed chair is more dovish, you've got the big deficits in the economy. You could argue that inflation, having come down to the sort of 2.5% to 3% range in the US, maybe that's the floor, or maybe it's going to go up from here. So that would be a concern. But if you get higher productivity growth, then it's easier to have faster wage growth while keeping prices down. And the same goes for government deficits. There are problems. US has a deficit even after tariffs of about 6%. France is 5%, struggling to deal with it. UK is about 4%, also struggling to deal with it. Even the US, they've done the tax cuts, they've promised spending cuts, but for the most part, those spending cuts are backdated and may well not come. So it's very difficult to cut deficits, obviously increasing defense spending. But productivity could help with that because it would raise revenues relatively quickly. So as long as governments don't simply spend it all, then there's a decent chance you can bring down the deficit. And that's what happened in the US in the 1990s. Then you've got the tariff uncertainty. That could still be a problem. But as I say, I think productivity can help with that. And then I want to come on to geopolitical risks. So this has been a lot of talk about this, and I want to just run through it quickly and then try to say what I think what might be the implications for markets. Before Trump, the US, as we know, there was NATO, basically nurturing alliances with Europe, with Asia, Canada, respecting international rules, for the most part, certainly paying strong lip service to it. And Russia, especially after Ukraine, was a key adversary, China for some time, and Iran for much longer, of course. With Trump, it's transactional. And we've seen that with Greenland. There's a Western Hemisphere focus, Greenland, Venezuela, Canada, Cuba. Um, then I think Russia is no longer seen as a key adversary, but China is. But the US commitment to the rest of Asia, I think, is a little bit uncertain because of this transactional approach. So, what should we expect in the foreign policy area? Well, first of all, defense spending is up everywhere. That's clear. That's what's happening in Europe, but in Asia as well, in Japan, in Taiwan, Korea. And I think, well, it hasn't happened much in the US. I think it will happen. The US NATO guarantee is in doubt, which puts a lot of pressure onto Europe. We've seen that. In my view, Russia is threatening, but it is containable. But Europe has to step up. And then you also have China with, I think, a very weak economy. I haven't really got time to talk about it. They've said that they're growing at 5%. I don't believe it. I think the real number is 2 or 3%. So probably slower than the US. But they're growing military. And so there's a risk of a move on Taiwan in the next few years. And in a sense, Trump has given them the playbook on that with his blockade of Venezuela. That would, I think, be the way it would start, a blockade of Taiwan. So that's something to worry about. And the US is still ambiguous on Taiwan, which obviously creates the risk of miscalculation. There's the possibility that more countries go nuclear. Certainly, a number of them are talking about it. And in the background, we've got India rising with very fast economy. India's economy was the fastest growing last year, around 7%. So it's coming from behind, but it's coming up fast. So there's a lot changing in the geopolitical area. What does it mean? Well, rising defense spending, I think, means higher interest rates and higher bond yields. So that's something to watch. It's partly because of stronger growth from the spending, and it's partly because of larger deficits. Maybe we'll see Europe integrate faster, not fast, I don't think, but maybe faster. And I think the biggest problem is the risk of geopolitical crisis, and there I would say Taiwan is the key one. But you could also see Russia push on NATO and on Europe. For example, supposing Russia, with or without ending the Ukraine war, was to try to take over Estonia. This would put a huge pressure on NATO, which should be responding much more than it has with Ukraine. But that would be a big step. Some people could argue there's less risk of geopolitical crisis if China loses, in a sense, Iran, Venezuela, Cuba. If we do see regime changes there, maybe that could help. And maybe we'll see the end of the Ukraine war soon. That if Russia, well, if you can make any sense out of Trump's policies, maybe one of the things he's trying to do is to pull Russia towards a more a better stance, shall we say, towards the world, making more friends. So maybe that could happen, but I don't know. So just to conclude on the economics, then I'll show just a chart or two on valuations and then hand over to Gerry. So I think the US is going to continue to grow strongly. The second half of 2025, we haven't got all the data in yet, but it looks like we're going to be looking at growth in the 4% area for the second half. And probably AI did play a role in that in terms of demand. It's not clear that it played much in terms of productivity. That's still unclear. Meanwhile, UK, Europe, Japan, 1 to 1.5% growth. That's near the trend for these countries. Unemployment should stay about the same. You need the productivity from AI, from deployment of AI, to get that up. We'll see if that happens. China, as I've said, sluggish growth, slow adjustment to the property crisis and to the overinvestment. They do have some very strong sectors, EVs, AI as well. But the older sectors are really struggling at the moment and confidence is low. I think the interest rate easing cycle is largely over. There's still one or two possible in the US or UK, but in the US, I'm not even sure about that. UK probably has room for a couple of cuts, I would say. So this should be a good environment for stocks. Obviously, they're already up a lot and valuations are up. This is the cyclically adjusted price earnings ratios. You can see the US is as high as it's ever been, apart from during the 99-2000 bubble. If you look at the EU there, the green line, you can see it's pretty high relative to the last 15 years or so, although below where it was in the early 2000s. And even the UK is relatively high in its 15-year range. Um, so I don't think the EU or the UK are expensive, but they're not as cheap as they were a year or two ago, I think. And finally, on the yield curve, this is just the yield curve with the 10-year yield less the federal funds rate. And as you can see, it's come back to positive. So the Fed funds rate has punched below the 10-year yield. Historically, it's quite common to have a much bigger spread between these two, even without having very low interest rates. So obviously, soon after recessions, you often get very low federal funds rate. That's when you get the 2 to 3% slope. But even when growth is pretty strong, it's not uncommon to get 1%, even 1.5%. So we can get further cuts in federal funds rate without any decline in bond yields. And if markets become concerned about inflation again or about deficits, then there's certainly a potential for bond yields to go higher. And with that cue, I'm going to pass on to Gerry.
Thank you, John. That's a great way to end. We'll just go straight into my bond yield chart. Hi, everybody. The reason we look at charts at Tricio is to try to see where our views stand with the rest of the market. It's very hard to hide your intentions when you actually have to trade markets, and you leave footprints on the price and momentum and all that sort of stuff. So in terms of the bond market, this is a long-term chart. I think it's a weekly with 13-week and 50-week moving averages like other charts are. And we've been pretty relaxed about the US bond market for some time now. We had the big wobble in 2023 where we saw a 5% approach in a 10-year. And at that time, we were saying, look, that seems pretty high. We're looking for bond yields to retreat from here. And we were more or less on the right side, as was the market. Most people expected that as well. And since then, we've seen this throttling back and forth in US bond yields. And it's one of those things where we debate this quite vigorously at our Tricio Investment Committee meetings, where I say the Fed's lowering rates. Yes, we expect the coupon curve, the spread between the 10-year and the 2-year to steepen. And that's gone up beautifully from being negative to quite positive, above 60 basis points at times. So it's one of those things where that part's gone right. But what hasn't gone right is that the 10-year has really, really failed to work below 4% on a sustained basis. We had to look at 3.6 in 2024, right before the Fed started lowering rates. Bond yields went down ahead of the Fed lowering rates, fair enough. Then we had the move to around 3.8 right after the Trump tariffs in April, the tariff tantrum, if you want to call it that, where bond markets caught a huge bid. But then since then, they backed up. Now, the risk here, as far as I can see, is that bond yields actually perk up. John's been talking about the US economy doing quite well. He's been talking about some risks here and there. And the bond market seems to be saying, John's right. There's a heck of a lot of spending coming through. Revenue hopefully will pick up, but at the moment, the deficit's pretty big. And everybody knows that the government's going to be issuing a lot more debt. So you've actually seen the Fed having to do, and nobody wants to call it QE except skeptics, but it is a bit of QE that they've returned to in terms of the front end and some of the money markets. And it's one of those things, the dislocation of the bond market is starting to cause angst in other bond markets. Other bond markets are causing angst in the US bond market. So it's kind of spreading around a bit. So far, nothing major. But on the chart, if we start building above 4.2, like we started doing this week, then we've got to be thinking about what's the upside risk. Well, upside risk in here would be around 4.6, which is where that falling blue line is. And if we start doing damage above 4.6, then we've got that 5% reference point from 2023. And then you've got 5.3, that's that horizontal purple line in the middle. And then you've got very little till 8%, which is like a horrible, horrible, horribly high yield, which we're not expecting to see. This isn't some sort of retreat back to the 90s and let's all go listen to Britpop again. No, it's one of those things where we're saying, look, our view that we might see dips below 4%, that's been limited and maybe even more limited over the coming year, maybe year and a half. And the risk, if there is a risk, is that it's shifted to the upside. So it's one of those things that we think people need to be aware of. Okay, so bond yields might tick a little higher. Does this really matter? Well, it does, because as equity market participants know, a lot of earnings, a lot of estimates, a lot of valuations are done with respect to bond yields. So if bond yields go up a lot, all of a sudden that starts cramping your metrics. And that's something that may come back and haunt the market. We're not looking for 2022 again. We've again debated this. But that was a big wake-up call for a lot of people. Bond yields can go up and stock markets can go down at the same time. So it's one of those things where we're not looking for that confluence of events, but the risk is that bond yields might perk up, and that just might take a little bit of steam out of stocks. This is NASDAQ 100. The reason we look at this is obviously, as John mentioned, it's a good barometer of tech shares in the US, where all the big momentum has been over the last 3, 5 years, depending on how we want to look at it, or since 2015, which is another way of looking at it. So this is a semi-log chart. Again, it's a weekly. The semi-log makes sure that you're looking at the same moves percentage-wise rather than the arithmetic one, which would tend to make things a bit messy and realistic. So on this measure, you can see we've come a long way since the global financial crisis, and we're in the middle of this bull trend, and we could actually extend higher. What we're looking at, though, is it's kind of meandered a little bit over the last few weeks, and we're looking for a bit of a pullback. So that could see a move back to the 50-week moving average, which is around 22,860. In a big bear case scenario, the bottom of the channel, which we're not expecting to be tested, would be around 17,700 at the moment. So it's one of those things where, for long-term investors, this is where we are. Bit of no man's land, still in a bull channel. So we have a neutral position for this in our asset allocation. Those of you who read our quarterly FEs will see that in our monthly insights. But it's one of the markets where, yes, we like it, but we are very wary, as John pointed out, some of the valuations are a little bit extreme. Not extreme, they're a little bit high. Again, similar chart, but S&P 500. The way we've drawn the channel here, we're pressing on the upside of it. Pullback risk is quite high. Again, mostly because we've come a long way, and you don't usually leave the 50-week moving average this far behind for this long. We're not looking for a huge down move. 50-week moving average is around 6,280 now, so it's a moderate down move. Again, you should expect this at any year. 5%, 10% pullbacks are not uncommon. However, if things get really scary, if you want to put it that way, the blue line, which is the kind of in the middle of the bull channel, that comes in around 53.50. So that's one of the lines that we would say, keep in mind, you don't really want to be breaking that because then you get all the way down to the bottom where the red line is, which is around 4,100. And we don't anticipate that sort of deep pullback. We just put it there because that's the bottom of the channel, and that defines how we've been moving higher over the last few years. Now, this is Japanese topics. People who've been attending our webinar since 2020 know that we've always liked the turn higher in Japan. We think a lot of things came together quite well over the last 5 years for the Japanese stock market, and it's done well. New all-time highs. These are levels we thought, well, we didn't think, but the market thought we'd never see again because we last saw these in the late 80s. So it's one of those things where we've come a long way. There's still a lot of positive influences here as far as we can tell in the economics and the fundamentals and in the way the market is treating Japan now as being very investable. Okay. John showed you those figures in terms of the profits. And again, I was surprised to see them, but it made a lot of sense. This is why people have been piling into Japan because it actually makes sense. So on a technical side, again, it's a bull channel. Again, we're testing the upside of it. So yes, we're very wary, and the door is quite open for some pullbacks. But we would think that the 50-week moving average here is probably going to hold. That's going to be around the 3,000 area, and we think that that probably would hold on any deep pullbacks. We're not looking for a retreat much below there, but those two little lows are around 2,200. That's in the middle of the channel at the moment. So we're definitely not looking for a retreat to the bottom of the channel. So moderate pullbacks are possible this year. We would expect that demand would remain high, though, and you'd see it pop back up to the top of the channel after any pullbacks. And the FTSE 100, this was a great mover last year. And it's one of the ones I think caught a lot of people by surprise because there are very few tech names in the index. It's very old school, miners, oil, banks, pharma. That seems to catch, a little bit of tobacco and I guess drinks. But it's one of the ones that we liked it because it has a decent dividend. And we've always thought that the FTSE represented a decent diversification exposure for a lot of investors. Also, for sterling-based investors, it does provide some sort of international model. So if sterling goes weak or weaker, then the FTSE 100 seems to, ever since Brexit, catch investors' attention. So it's one of the things that kind of fits in a portfolio pretty well. Now, again, we're testing channel resistance. Pullback risk is high here. We're not looking for a big break lower. The 50-week moving average is probably as bad as I think it's going to get if we do have a pullback. That's around the 9,100 area. So hopefully it doesn't get much below there. Finally, this is the last of my slides. And what we've done here is we wrote about this, I think once in a weekly, and I think we may have mentioned it in one of our monthlies. And it's the view that, as John said, AI isn't just a US phenomena. It's one of those things where, yes, the focus is on the big US names in terms of chip production, chip design, chip implementation, and all the hype, if you want to call it hype, or froth, depending on how extreme you want to think that market is getting. But China, with their DeepSeek model last year, did shock the market. And the idea that something could be good enough is actually not one that should be dismissed. So it's one of the ones where when we look at this, we say there is definitely room for exposure to different markets that maybe are not as overvalued, if you want to call it overvalued, as some markets. So we would suggest looking at UCITS, ETF, it's iShares, it's got some of the names that you'll be familiar with, and it's got some names that you won't be. Obviously, keep in mind that there are political risks here in terms of, the Chinese government has leaned against excessive speculation in some shares. People have come out and said, look, we're not going to make that much money. I don't know why you're buying us. You've already gone up 30 times, relax. Which again, it is you don't see that in the States. You very rarely see a CEO in America come out and say, quit buying my shares. They're not going to go up fast. But China's different. So it's one of those things where if you want diversification, you think about different ideas, there are different things to do. And one of the ones that we've looked at is China, where some of the huge amounts of companies are trying to do this. As John said, it's open source. It's a different way of doing it. It may provide a different solution. And if you are looking for AI or tech in general to continue to do well around the world, it may be something to consider. Now I'm going to hand over to James Chu. He's our head of investment solutions, and he's been writing about geopolitical risks and how people should do their thinking about this on LinkedIn a few times. If you haven't seen it, please make sure you hit him up on LinkedIn, and that way you can see his posts. James, over to you.
Can I go back one slide, please? I just don't want to show this slide yet. I'm not going to talk about this slide, but I just want to give some background first before I go to that slide. So as Gerry said, I posted a couple of LinkedIn posts purely because we all sense that 2026 there will be a lot of geopolitical noises, issues, events, and we have seen in quite a bit already 3 weeks into January. And the focus on my LinkedIn posts really were to advisors who may have retail investor, and these retail investors tend to get really panicked when they hear this. Oh, how can I deal with this? So much up and down. They try to put everything in cash or other savings and or put everything into other safe haven assets. I just try to on a LinkedIn post say that we focus on the long term, think about economic fundamentals, etc., which, like John has said, he listed out all the geopolitical risks and likely impact on the market. Think about your long-term goal, etc. And the key is to stay calm. I think calm means obviously deal with our emotions and psychology. Emotion obviously affect us. In the current environment, we feel fear, but we could have a reverse environment that we become complacent or overconfident. Oh, the Ukraine war is going to end. Let's go all in into stocks. That's another extreme of getting all into cash. So that is a emotional factor that we recognize. Always basically say, hang on a little bit, and that's when you start to say, calm down. And also, I'm not going to talk a lot about this, but if you look at the psychologist writing, behavioral finance writing, they always talk about narrative bias. We as human beings like to form stories in our head. We want to basically form stories to justify what we think, our decisions, our emotion. For example, we don't like someone, we think a story that explain what he or she does is bad, and to explain my feeling. And then after that, I start to dislike that person even more. And then we form more stories about that person. It just go on and on and on. So we have that bias in our head. So that's one thing we to deal with when we're calm. Again, try to calm down, know that actually are we trying to form a stories against what we're trying to say. And obviously, the other thing is a famous psychologist and Nobel Prize economist, Daniel Kahneman. He passed away a couple of years ago. In his book, Thinking Fast and Slow, he basically say we have two systems of thinking. One is fast, one is slow. System two thinking is when you calm, be analytical, but it takes up a lot of our energy. It consumes our sugar. It takes up a lot of our cognitive resources in our brain. We don't like it, and we tend to use system one. Oh, Trump is talking about Greenland. He imposed tariff. System one thinking go all in, and we start to think of stories, and the story fit into our emotion. We panic or go complacent. That's what happened. So that's the background, and I think this is just I want to give a bit of this background and about the linking why I write the linking post. I'm not a geopolitical analyst, but I think it's important that we, as professional investors or advisors, need to deal with our emotions and psychological biases. Yeah, we talked about the first thing already about the psychology. One way to do it is to take a war room approach, and this is when I guess maybe some of the EU countries were doing last week when Trump threatened with the tariff and basically say, let's form a war room and basically deal with it. A war room approach needs real-time data because things keep changing. What is being said by politicians or what they think or how they act change time to time and is worse during a geopolitical crisis. So we need a real-time update and we need cross-discipline expertise in a war room. In theory, we need economists like John. We ideally need a geopolitical analyst, a country specialist, etc. And then need to design and act fast, properly. Now, think about it. Do we actually have all the resources to have a full war room? Some of you may have, some of your company may afford to do it, but in general, no. And you try to do it yourself, you basically, your system two thinking probably get actually overwhelmed and you basically got so tired connectively. So that's why I think this is important. Basically is, yes, we could try to be calm and analytical, but we can't afford to take this over analytical approach at war room, etc. That's why I think I go back to a couple of points in the next two slides. These matters can actually be a webinar on its own, which we can do in future, but let's jump straight to some quick conclusion. So the first thing is in investment horizon. Some of these events do not matter to very long-term investors because the evidence that actually geopolitical crisis cause short-term correction in stock market, maybe some in bond market, but it recover. Everything seems to mean reward. So, but on the other hand, it represents short-term opportunities. If you're a long-term investor, it's important you stick with your investment horizon and don't get actually try to let's do something actually maybe for a week or 2 weeks trade. It may actually create more damages to your portfolio returns. Or if you really want to do that, find an advisor to work with you. Second, think about that. Remember all the decisions you make in when you face this geopolitical crisis is still about your investment goal. Why I say that is sometimes we talk a lot about, for example, when we talk about the Greenland thing, I think a lot of the talks become what Trump is thinking, why is he doing this, etc., etc. Interesting talk, has nothing to do investment goal. Think about that. It is important to focus on your investment goal, which link to your investment horizon. Third way is exactly what we try to do with good analysts, etc. We sometimes tend to overthink. We probably think of a decision tree, what Trump will do next, or what Putin will do next, what this EU countries will do next. You start to have a huge decision tree, and you try to think of the unthinkable. You think of the black swan events, etc. Okay, all good exercises, but remember, it takes up all your cognitive skills and your cognitive resources. You feel tired, you overthink. When you're tired, you overthink, you get overwhelmed, you start to get emotional. and you start the biases kick in. So there may be a right balance there. It's not for today's webinar to talk about what's the right balance in terms of the possible scenarios, but just don't overthink. That's what we try to do a lot. And then the do's. One of the saying I saw from a Harvard Business Review author is hold strong opinions weakly. Okay, as a politicians now, they won't hold, actually they won't say this is the wrong way to do politics, but for us as investor, hold strong opinions weekly. Be open-minded. Update your information, change your wheels. There's nothing wrong to change your wheels. Okay, if new information arrives, you need to adjust. Some low probability event may become higher, some high probability scenario now won't happen, so take all this into account. I keep saying, and in LinkedIn post as well, keep diversified. Okay, we talk about AI. AI is not about US. There's a China game as well. Diversify, diversify, and currency also matters. And this is when Gerry always have some input on basically how currency affects. Probably more about entry points when you try to enter the market now. Maybe some currency effect need to consider. Should you use hedging or not? That's something you may need to consider. But overall, keep diversified. And if you are set to actually trade or take advantage of short-term opportunities, it's important. I think most of you have, but if not, have an objective and discipline entry exit plan. Sometimes they call risk management system, sometimes it's called profit taking system. Just follow it objectively. You set that you take profit 5%. There's a reason behind it. You document it, then do it. Okay. If the market drop 5% and then drop another 5%, what action point? You write it already, and you basically stick to it. The most important thing when you trade or invest on the short term in the when there's geopolitical events is actually you don't control the risk, and you got emotions actually kick in and try to hold on a losing position for too long, etc. So just be aware of this. So just a quick overview. There may be some in future webinars will talk a little bit more about this, but yeah, I'd like to now end.
Thank you, everybody. Thank you, John, for leading this awesome webinar on AI. And thank you, James, for adding perspective on geopolitical risk. For further information on Tricio and what we offer, please don't hesitate to contact us on LinkedIn or info@tricio-advisors.com. That's advisors with an O. Thank you, everybody, for attending our webinar.